All right, heroes, here we are back. So, in two previous lessons, we talked about what correlation is and actually the numbers behind how we figure out what correlation is. Then I showed you how to find it on the Thinkorswim platform, which again is the platform that I use. And any real serious trader should actually be considering using if they're not. Um, so here we are back. So most like 90% of the information that is really easily available to you on the Thinkorswim platform um, is all here. There's only one difference between this correlation Google sheet and the TD Ameritrade Thinkorswim platform. I'll get to that in a minute. But let's talk about what this is, because this is yours, right? There's a download link below. This is absolutely yours. What we have up here, everything starts with what's in B1. So B1 is SPY. That's the S&P 500 Index ETF. Everything on this sheet is going to be correlated and compared and put into algorithms based off of SPY and all the stock equivalents of SPY, right? You can update that. Like if all your holdings are based off of like NASDAQ stocks, you can update it to QQQ. But for 99.99% of you, you want to just leave it as SPY. It's the number one index that everyone looks at. It has the most different stocks in most different sectors and countries and emerging markets and all this jazz. So it gives you a good overall understanding of what is going on in the stock market at any given day. So what we do here is we want to add not only stocks but also some positions like stock holdings to this sheet to give us a few things. Give us their correlation to not only one another, but also to SPY, right? So it will also give us our beta weighted. So how many shares of SPY up or down do we have based off of how many shares of stock we have? What the notional value is based off of those shares and its beta weight to SPY. What can we expect to happen if the market goes up 2%, up 5%, up 10%, down 2%, down 5%, and down 10%? And then at the same time, based off of the expected move of SPY and the positions that we have that are beta weighted to SPY, how much can we expect to lose in the next 1 day, 30 days, 90 days, or 365 days? So if you have a $25,000 account and the worst you could lose is like $3,000 in the next 365 days, well, hey, maybe you can sleep a little bit easier at night knowing that, hey, you're not at risk of like your entire account blowing up just based off of how everything stands right now. So let's do some, shall we? So let's say we own Facebook, right? And see, it's populating. So Facebook has about a 50% correlation to SPY. That's not bad. That's actually something we can move forward to. And let's say we own 10 shares of Facebook. Right now, that's going to cost you about $1,600. And based off of the price of Facebook and its beta, that's about 2.35 shares of SPY. So that's not bad. So if you look at that right now, we can see if SPY goes up $2, we can expect to make $11.47. And just owning 10 shares of Facebook, we're really not looking at anything more than $88 in losses in the next year, just based off of everything is right here. Let's look at another one. Let's say USO, which is the United States Oil Fund. So it's an ETF that is supposed to track, however, quite poorly, the price of crude oil. And let's say we own 30 shares of USO. All right, so together now we're at about 4 shares of SPY with a notional value of almost $2,000 here, right? So that's what it is, and we can see again now we have different expectations about, hey, what happens if the market goes down 10%? Well, we expect to lose $95, right? The market goes up 10%, we expect to make $95, that kind of thing. Let's look at another one, the US dollar. Right, so the US dollar is not very correlated at all to SPY. This is really good, guys. Let's say we own also 30 shares of the US dollar ETF. This is pretty good. Now we're about 6.67 shares long of SPY. Really, really good stuff. And now we have reasonable expectations about what will happen to our position in certain price movements and what can happen to our positions over a certain amount of time. Really, really cool stuff, guys. And what you can see here is this portfolio is not very correlated to SPY, and that is really, really huge. The reason that's so big is, remember, the goal for us heroes, the way you make money in this game, guys, is pretty simple. You need a lot of uncorrelated positions that give you a greater than 50% chance of making money, right? Facebook, USO, the US dollar are very not correlated to SPY. So this would check off our box of having a portfolio of non-correlated positions. And if we scroll down a little bit, we can see how they are correlated to one another. Remember, correlation closer to 100 is highly correlated. We want to stay away from that. Correlation close to -1 is very negatively correlated, and we want to stay away from that if we can. We want to be as close to 0 as possible. So this is really, really cool to see. We can see a portfolio that is completely not correlated from one another. The way I view this and the way you guys should be viewing this is quite simple. Facebook moves in terms of price, right? So here's the price movements of Facebook. Here's the price movements of USO. Here are the price movements of UUP. Facebook moves with similar price to USO 3% of the time. Facebook moves with similar price movement to UUP, which is the ETF for the US dollar, at about 0% of the time. Completely not correlated. Really, really cool. Now, if we look at the US dollar and oil, they don't move together at all or opposite from one another. So they're completely random. So this is really, really cool because, again, this is a portfolio, at least in terms of just names, that is completely not correlated from one another. Again, going back to the Wall Street term of diversification, USO and UUP are commodities. Conventional wisdom would say you don't want to have too many commodities because they're in the same sector, right? That sector is going to move together with one another. But we just showed here, based off of this cell, that USO and UUP, which again, USO is the price of crude oil, UUP is the price of the US dollar, are completely random in terms of price movements from one another. Excuse me. Those price movements are completely not correlated from one another. So you just have a very nice opportunity here if you want to get long both USO and UUP because they're not correlated to one another. Again, Wall Street conventional wisdom, financial media would say you can't buy both USO and UUP, which again is crude oil and the US dollar at the same time because they're both commodities. That is not true because based off of their price movements, which again are facts, based off of those price movements, they don't move together whatsoever. The price movements of USO and the price movements of UUP are completely random and independent of one another. That's what's so cool about this. So again, the number up here is the stocks you have, their total combined correlation to SPY or whatever you put up here. The beta weighted position is based off of the amount of shares you have and the correlation and a few other algorithms. Your stock equivalent of whatever is in B1, in this case is SPY. This is your notional value. And again, this is what happens when we stress our positions up or down 10% or 5% or 2% based off of the price movements of the last year and the notional values of those price movements compared. This is your expectation. And also based off of the expected move for 1 day, 30 days, 90 days, and 1 year in SPY, your portfolio can expect to make or lose this much money. Um, this much money. So really, really awesome stuff here. And again, the goal is to have as many not correlated positions as you can that give you a better than 50% chance of making money. So again, this is really, really cool. Anything to the dark green we want to stay away from. So let's add Google here. Let's say we have 5 shares of Google. Great. So we have 5 shares of Google. So this changes. So let's go down here. So we see that Facebook and Google move together about 70% of the time. To me, I would say that's highly correlated. We would not want the same directional position in both Facebook and Google at the same time because those are very correlated to one another. We might as well double up on size to one of them if we want that type of exposure. But again, Facebook moves with oil 3% of the time. Facebook moves with the US dollar 0% of the time. Those are completely not correlated from one another. Facebook and Google, however, move together 70% of the time. Those are quite correlated from one another. Let's look at another one like Microsoft. Again, a technology company. All right, that moves with Facebook 50% of the time. Not bad. You can go ahead and you can make trades based off of having the same directional risk as Facebook and Microsoft. What about Apple? Let's see how that one looks. Again, these are all happening based off of real-time data. So Apple and Facebook only have a 49% correlation. That's not bad. You can go ahead and make trades in those positions. So again, not bad. Again, see how we can change the stock, and let's do Netflix here, how everything gets updated in real time. The correlation gets updated. The beta gets updated if we change the price here. Notional value is obviously now, or percent of portfolio is more heavily into Netflix. So what you could do here in this scenario is, let's say this is our portfolio right here, right? This is our portfolio right here. It is predominantly 76% in Netflix. So what you could do in this scenario is, remember, all these numbers, all this stuff is based off of comparing to SPY. But if we have a portfolio that's comprised of 10 shares of Facebook, 30 shares of USO, 30 shares of UUP, and 50 shares of Netflix, that portfolio in itself is mostly comprised, again, 3/4 of it is comprised of Netflix. So what we can do is we can go up here and we can add Netflix. And now we're comparing all these other positions to Netflix, right? And now, because the majority of our notional value is in Netflix, now we want to say, okay, I own all this much Netflix. Now let's see if we add positions onto it. So instead of Facebook, we could say, okay, I'm interested in getting long, let's say, Tesla. Now, what does that look like? There we go. So what does that look like? So Tesla, remember, Tesla is in the NASDAQ just like Netflix. It's a technology company just like Netflix. It's a high beta company just like Netflix. However, its price movements only move with Netflix, remember, because I have Netflix up here, 26% of the time. So I can go ahead and have the same directional risk as I have with Netflix with Tesla, because again, I'm just going off of pure price movements, not the fact that they're in the same sector or they are both trade on the NASDAQ. So again, it's really, 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 really key here that it's based off of pure numbers. So again, you'll be able to download this sheet. You can go up to this many stocks. Again, if you want me to add more stocks to this, I'm more than happy to do that. Just shoot me an email at steven@stonybrooksecurities.com. If you have any questions, just let me know. Fire away. I'll try to give you an answer as quickly as you can. This section down here, where you're comparing your entire portfolio against itself, is the only thing that this sheet has that the Thinkorswim platform does not have. Everything else on here, we've shown you in the last video, is that you can find on the TD Ameritrade, the Thinkorswim platform. But again, this is yours. This is actually yours to keep. That comes with the course. Any updates I make to this are yours. Any additions, any changes, if I make more of these, they're all yours. But again, it's pure price movement. It's pure price movement. We blew the doors off a lot of stuff here. Remember, Netflix and Tesla. Netflix and Tesla, guys. Netflix and Tesla are in the exact same index. They're both NASDAQ. They're both technology. They're the same exact sector. However, Netflix and Tesla only trade together price, pure price, 26% of the time. So rather than saying, no, stay away from Netflix and Tesla, that's not diversified because they're in the same sector, I say that's hogwash. If you want to have the same directional risk in Netflix and Tesla as you have, you can totally go ahead and do it because they only move together about 26% of the time. That's a very independent price movement. Same thing with USO and UUP. USO is a commodity. It is the commodity for crude oil. UUP is a commodity. It is the commodity for the US dollar. They move completely random from one another. Completely random from one another. So while conventional wisdom will say stay away from buying for having the same exposure to crude oil and US dollar at the same time, I say go ahead because their price movements over the last year have been completely random to one another. This is a very, very powerful tool, guys. This is not using the high level, the not fact-based, the not price-based, kind of the more subjective, way of thinking that Wall Street tends to have. Sectors don't matter. Diversification doesn't matter. It all has to do with correlation. And remember, to make money in this business, guys, it's not hard. It's really not hard. I can summarize it in one sentence. And again, it's to have many non-correlated positions that all have a better than 50% chance of making money. This tool in itself and everything that has come in this lesson, the videos that come in this lesson, will get you to the correlation part. So go out there, guys, make some money. Again, if you have any questions, it's Steven at StonyBrookSecurities.com.